Now, to fully understand the significance of the central bank's move, we have to dig deeper into the mechanics of how currency supply connects to value. Think of the economy as a balance. On one side, you have the dinar. On the other, the US dollar. For years, that balance has been skewed because so many dinars were in circulation, while demand for dollars remained high. Every importer needed dollars. Every saver trusted dollars. Every smuggler, every external payment, every black market transaction tilted the balance toward the greenback. When the central bank announces a reduction in dinar supply, it's essentially saying, we are pulling some weight off the scale to restore balance. Fewer dinars chasing the same number of dollars could, in theory, strengthen the dinar. But here's where the speculation really begins. Is this just about day-to-day stability? Or is it the quiet preparation for something much bigger, like a revaluation? Let's consider Iraq's unique position. Unlike many countries whose currencies float freely on international markets, Iraq's dinar is managed, partly fixed, partly adjusted, under the heavy hand of the central bank. This means that changes in policy are often intentional, not accidental. When the bank tightens supply, it is not simply reacting, it is signaling. And the signal today is unmistakable. Iraq wants to wrestle control of its exchange rate back from the streets and align reality closer to policy. Now imagine the potential ripple effects if this move works. Let's say the street rate, currently around 1,430 dinars to the dollar, begins to slide closer to the official 1,300 rate. Confidence returns. Inflation cools. Businesses start planning again with more predictability. At that point, the central bank would face a choice. Do they hold steady, locking the dinar at its current level? Or do they make a bold announcement, revaluing the dinar upward to signal strength, reward stability, and reset the market psychology? This is where history whispers in our ear. Central banks around the world often use scarcity, whether of money supply or interest rates, to prepare for revaluation. It's like tightening the strings on an instrument before playing the big note. Iraq's move today feels very much like that tightening. But the big note, the revaluation itself, requires perfect timing. Too early, and it risks destabilizing the fragile balance. Too late, and the opportunity may slip away. We also need to look at Iraq's reserves. As of mid-2025, the central bank reported gold holdings of nearly 23 trillion dinars, about $17 billion worth. Add to that tens of billions more in foreign currency reserves, largely fueled by oil revenues. This war chest is the ultimate weapon in defending the dinar. If reserves are strong, the bank has the credibility to adjust rates. Without reserves, any talk of revaluation would be empty words. That is why today's announcement is being read as more than just a technical adjustment. It's backed by real reserves, real resources, and a real plan. But what about the risks? Pulling dinars out of circulation also means tightening liquidity. Businesses may struggle to access cash. Households may find credit harder to secure. If the squeeze is too severe, it can choke economic activity. Inflation may drop, yes, but at the cost of slower growth. And politically, the public may grow restless if they feel the pinch without seeing the payoff. That's why the central bank must play this carefully, balancing short-term sacrifices with long-term gains. And then comes the elephant in the room: oil. Iraq's entire fiscal position rests on oil revenues. If oil prices stay high, the central bank's strategy gains momentum. Dollars flow in, reserves grow, confidence builds. But if oil prices fall sharply, everything changes. A weaker flow of dollars would undercut the very foundation of this strategy, and talk of revaluation would quickly fade. In other words, the dream of a stronger dinar lives and dies with the price of oil. So let's return to the central question. Is a revaluation coming? The honest answer is this: today's move does not guarantee a revaluation. But it undeniably creates the conditions under which a revaluation becomes possible. Think of it as laying the tracks for a train. The train, the revaluation, may not have arrived yet, but the tracks are being built one policy at a time. Reducing money supply, building reserves, tightening oversight, all of these are the tracks. Whether the train comes depends on timing, politics, and global conditions. For Iraqis, This uncertainty is both exhausting and hopeful. On one hand, they feel the squeeze as liquidity tightens. On the other hand, they hear whispers of a stronger dinar, a day when their money buys more, not less. For dinar holders outside Iraq, this news fuels endless speculation. Forums light up, analysts debate, and the age-old question, when will the RV happen? Echoes once again. But let us not lose sight of the human side. In Baghdad's markets tonight, a father counts his dinars carefully as he buys groceries. In Basra, an importer nervously checks his accounts, calculating how many dollars he'll need for the next shipment. In Erbil, a money exchange clerk updates his board for the 5th time today, watching customers shuffle in with worried faces. For them, this is not about abstract policy. It's about survival, stability, and hope. As we look to the days ahead, 3 signals will tell us if Iraq is moving closer to a revaluation. First, watch the spread between official and market rates. If it narrows significantly, that means the central bank is winning. Second, watch reserves, both gold and foreign currency. If they continue to climb, confidence in Iraq's ability to defend the dinar grows. And third, watch politics. If the government unites behind reform and stability, the chances of a bold move like revaluation increase dramatically. So tonight, the story is clear. The central bank has reduced dinar supply. That alone is a major step, a rare and deliberate move. Does it mean revaluation tomorrow? No. But does it mean Iraq is preparing the ground for something bigger? Absolutely. The game has changed, the tone has shifted, and the world is watching. As always, currencies are not just numbers, they are symbols. The dinar reflects Iraq's struggles, resilience, and aspirations. The dollar, in contrast, reflects global power and trust. The tension between them plays out not only in exchange shops but in the hearts of millions. A revaluation, should it come, will not just be about money. It will be about pride, confidence, and Iraq's place in the world. So stay tuned. The central bank has made its move. The question now is not if change is coming, but how big, how soon, and how far it will go. As we wrap up this story, let's look beyond today and ask, what does this money supply cut really mean for Iraq's future, for the dinar, and for you? First, let's talk long-term impact. Reducing the money supply is not just about today's street rate. It's about reshaping Iraq's financial foundation. When there are too many dinars circulating, inflation becomes harder to control. By pulling some of that excess money out, the central bank is trying to create a leaner, more stable system where the value of the currency holds firm. If this policy is carried through consistently, it could restore trust in the dinar not just at home, but also in international markets. And that's critical. Iraq is a country whose economy depends heavily on imports. Food, medicine, cars, electronics, all are priced in dollars before they reach your local market. Every time the dinar weakens, importers pass higher costs on to consumers. A stronger, more stable dinar means families can plan their budgets without constant fear that the price of bread or fuel will suddenly jump overnight. But here's the big question many people are whispering about. Does this move bring Iraq closer to a revaluation of the dinar? After all, cutting the money supply makes each unit of currency scarcer. Scarcity can create value, and for years, there's been speculation that Iraq may eventually raise the official value of its currency. Some analysts see today's decision as laying the groundwork for exactly that, because you cannot revalue a currency successfully if there's too much of it flooding the market. Now, let's be clear. A revaluation is not guaranteed. It requires strong reserves, political stability, and confidence from both citizens and international partners. But what today's cut signals is that the central bank is willing to make tough moves to defend the dinar. Whether that ends in a revaluation or simply in a more stable exchange rate, the direction is unmistakable. Iraq wants to strengthen its currency, not let it weaken further. So what should you, as an ordinary citizen or business owner, do right now? There are 3 practical steps. Number 1. Stay liquid, but cautious. Keep some cash on hand for daily needs, but avoid holding too much in dinars or dollars without a purpose. The market may swing sharply in the coming weeks, and flexibility is your best defense. Number 2, watch the central bank's next moves. If they inject more dollars into the market, if they tighten banking rules, or if they announce new mechanisms for trade settlements, these will all signal how serious they are about stabilizing the currency. And number 3, don't chase rumors. Iraq's currency market is famous for speculation. Every week, there are claims of revaluations, overnight jumps, or secret deals. The reality is that change comes step by step. Today's cut is one of those steps, but it's not the final destination. Protect your savings, but don't gamble them on unverified claims. Finally, let's bring this back to the human level. For many Iraqis, financial policy feels distant, like something happening in government halls, not in daily life. But when you see the price of bread, the cost of rent, or the value of your monthly salary change, that's monetary policy at work. Today's decision by the central bank to reduce the money supply may feel abstract, but in reality, it is shaping tomorrow's markets, tomorrow's wages, and tomorrow's opportunities. In the best-case scenario, this cut leads to a stronger dinar, lower inflation, and a financial system that ordinary people can trust. In the worst case, it could create tighter cash flows without solving the deeper problems. Which way it goes depends not just on the policy itself, but on how consistently it's carried out, how politics align with economics, and how Iraq positions itself in a region where the dollar remains king. So, what today's money supply cut means for your wallet is this: a period of adjustment, a chance for stability, and maybe, just maybe, the first steps toward a future where the dinar finally gains the strength that Iraqis have long been waiting for. Because at the end of the day, every dinar you hold is not just paper. It's trust, it's policy, and it's a reflection of Iraq's journey toward economic independence. And today, that journey has taken another decisive step forward.